Welcome back, everybody. Today we are going to talk about something that is quietly unfolding in the silver market right now, and I think once you understand what is happening, you are going to look at silver in a completely different way. On the surface, if you glance at the silver price on your phone or your brokerage app, things might seem pretty calm. The number goes up a little, comes down a little, and nothing feels particularly alarming. But underneath that calm surface, there is a very different story being told. The physical vaults. The actual warehouses where real tangible silver bars are stored, those vaults are draining. And that gap between what the paper price is telling you and what the physical market is actually doing is one of the more important divergences playing out in any commodity market right now. So let's dig into this carefully and make sure you walk away understanding what is really going on. Let's start with a simple idea that is going to frame everything else in this video. The silver market, like most commodity markets, operates on two different tracks at the same time. There is the paper market, which is made up of futures contracts traded on exchanges like the COMEX in New York. And then there is the physical market, which is the real thing, actual bars of silver sitting in actual vaults that can be touched, weighed, transported, and delivered. Under normal market conditions, these two tracks run fairly close together. The price you see on the paper market more or less reflects what is happening in the physical world. But right now, those two tracks are moving apart from each other in a way that is genuinely worth paying attention to. Think about it this way. Imagine a concert venue that sells 10,000 tickets, but the venue itself only has seats for 2,000 people. As long as most ticket holders never show up expecting a seat, everything works fine. The system runs smoothly. But the moment a large number of people start actually turning up and demanding their seat, you have a real problem. The paper-silver market operates in a conceptually similar way. There are currently billions of dollars worth of paper claims stacked on top of the physical metal sitting in COMEX vaults, and the coverage ratio, the measure of how much deliverable silver actually backs those paper contracts, stands at around 16.6%. Meaning there is significant paper leverage of roughly 6 paper claims for every ounce of real, deliverable metal. The question that matters is not whether the system can keep running. It probably can for a while. The question is, what happens when more and more participants decide they want actual metal instead of a paper promise? Now let's talk about what is happening inside those COMEX vaults, because the numbers are genuinely striking. As of mid-April 2026, COMEX registered silver, the metal that is actually available and warranted for delivery, sits at roughly 76.8 million ounces. But open interest on the COMEX currently stands at around 575 million ounces. That works out to a delivery coverage ratio of just 13.4%, meaning for every single ounce of real, deliverable silver in those vaults, there are roughly 7.5 paper claims stacked on top of it. That is not a conspiracy theory. That is just how futures markets are structured by design. Most participants never intend to take delivery. They are traders, speculators, and hedgers who roll their contracts forward or cash settle. But the ratio matters, especially when more and more buyers start converting paper into physical, and that conversion is exactly what has been happening. COMEX registered silver inventory has declined over 80% from its 2021 peak, and what makes this particular drawdown different from previous ones is its persistence. Previous inventory drops reversed when prices rose or physical demand eased, but this time the decline has continued through multiple years and various market conditions. That is not a short-term blip. That is a structural shift. The World Silver Survey for 2026 confirms a cumulative drawdown of 762 million troy ounces, spanning 5 straight annual deficits, and the 2026 shortfall is projected at 46.3 million ounces, which would mark the 6th consecutive deficit year. 6 years. 6 straight years where the world has consumed more silver than it has produced. That is the backdrop against which all of this vault drainage is happening. Let's break this down a bit more. Inside COMEX, silver inventory is divided into 2 categories. Registered silver has a delivery warrant issued against it and can be delivered to fulfill a futures contract. Eligible silver meets COMEX quality specifications, but is simply being stored in the vault without a delivery warrant, meaning it requires re-registration before it can fulfill a futures obligation. This distinction is important because when people talk about COMEX silver inventory, they are often lumping these 2 categories together, which can be misleading. The registered pile, the pile that actually backs the paper contracts, is the one that matters most when we are talking about delivery pressure, and that is the pile that has been shrinking most dramatically. Back in February 2026, there was a single day where the exchange reported a negative adjustment of over 3.2 million ounces from the registered category alone, dropping total registered silver below the closely watched 100 million ounce threshold for the first time. On that same day, more than 4.7 million ounces were withdrawn from the eligible category, creating a net system withdrawal of nearly 4.7 million ounces in a single 24-hour period. One day. That is a significant amount of metal walking out the door in a very short time, and these large single-day movements are not random noise. They reflect real decisions being made by real institutions and real industrial buyers who are choosing to take possession of physical metal rather than hold a paper claim. Now this is important, because you might be wondering, if all this metal is leaving the vaults and there are 6 times more paper claims than physical silver, why hasn't the price exploded? That is a fair question. And honestly, it gets to the heart of why the divergence we are talking about today is so fascinating and so significant. The paper price of silver is set primarily on futures exchanges through electronic trading, and that market is massive and liquid. It responds to interest rates, to the dollar, to investor sentiment, to macroeconomic data, to all kinds of things that have nothing to do with whether vaults are full or empty on a given day. In early 2026, after silver reached highs above $114 per ounce, the CME Group raised margin requirements for silver futures contracts to 18% from 15%, which triggered widespread unwinding of leveraged positions and pushed the paper price down sharply. Margin hikes are a powerful tool. They force traders to either put up more cash or close their positions, and when a lot of leveraged traders close at the same time, prices fall regardless of what is happening in the physical world. So what you end up with is a situation where the paper market price can move lower, or sideways, while the physical market tells a completely different story. And that brings us to the second half of what I want to walk you through today, because the COMEX is not the only place where we are seeing this physical tightness play out. Let's talk about Shanghai, because what is happening over there adds a whole other layer to this story. The Shanghai Gold Exchange, or SGE, is fundamentally different from COMEX in how it operates. COMEX primarily trades futures contracts where less than 1% result in physical delivery. The SGE, by contrast, is designed for physical settlement, where traders take actual delivery of silver bars. This means SGE prices reflect genuine supply and demand for physical metal, while COMEX is more influenced by speculative positioning. This is a critical difference. When you buy a silver contract on the SGE, you are very likely going to end up with actual metal. That is the whole point of the exchange. So when Shanghai prices start diverging significantly from New York prices, it is a direct signal that physical demand in China is running hot. As of April 1, 2026, Shanghai futures were trading at approximately $84.59 per ounce, while COMEX May/June futures on the same date were quoted at around $74.94 per ounce, a spread of roughly $9 to $10 per ounce, or 12 to 13%, and this spread has been sustained since late 2025. Now let's think about what that means. If you could buy silver on COMEX for $75 and sell it in Shanghai for $85, the theoretical profit is $10 per ounce before costs. The arbitrage should be simple. Buy silver on COMEX, ship it to Shanghai, sell at a premium, and collect the profit minus shipping costs of maybe $1 or $2 per ounce. But the spread is not closing. Why? Because when traders try to pull physical metal out of COMEX to ship east, they are discovering that there is not enough available metal to move. That is the tell. In a fully functioning, well-supplied market, arbitrageurs close price gaps like this very quickly. The fact that this gap has persisted for months is not a minor technical anomaly. It is a sign of genuine physical tightness. The metal that would normally flow from west to east to close the spread simply is not there in sufficient quantities. China's silver imports in early 2026 hit their highest level in 8 years, with Chinese buyers paying a 12 to 13% premium above spot price, and locally in Shanghai, silver was trading above $90. Think about that from the perspective of a Chinese manufacturer who needs silver to build solar panels or electronics. They are not buying futures contracts for fun. They need the actual metal to keep their factory running, and they are willing to pay a significant premium to get it. That is real demand meeting real scarcity, China functions as the world's most consequential physical demand force for silver, one that increasingly sets a floor beneath global prices and shapes the direction of physical metal flows. Silver's dual role as both a precious and industrial metal makes China's dominance in manufacturing particularly consequential for price formation. And China is not alone. India is right there alongside them as an enormous physical absorber of silver, driven by jewelry, cultural traditions around savings, and growing industrial use. When you combine what China and India are doing on the physical side, you have a demand base that is extraordinarily large and remarkably consistent. Here is where I want to slow down and give you a mental model that ties all of this together, because I think it helps clarify why this matters so much. Picture two water tanks connected by a pipe. One tank represents the paper market. Enormous, full of financial activity, highly liquid, responsive to interest rates and economic signals. The other tank represents the physical market. Smaller, slower moving, driven by actual industrial need and real-world scarcity. Under normal conditions, the pipe between them keeps the two tanks at roughly similar levels. But when the physical tank starts draining faster than the pipe can refill it, and when that happens in multiple locations simultaneously, like New York and Shanghai, the pressure in the physical side starts building. The paper market can stay calm for a while, because it is so large and so disconnected from day-to-day physical flows. But eventually, the pressure has to go somewhere. When the coverage ratio, the percentage of paper contracts that could actually be satisfied with registered physical metal, holds below 15% for 6 straight months, what that tells you is that market participants who need deliverable metal are competing for a steadily shrinking pool of it. That is a structurally different market than what existed just 3 years ago when COMEX registered stocks were 3 times larger. The registered inventory has not just dipped. It has been hollowed out over an extended period of time, and the pace of that hollowing out has actually been accelerating. Now let's talk about the supply side, because the demand story only gets more intense when you look at what is happening with production. On the supply side, the world's largest primary silver producer, Fresnillo, cut its 2026 output guidance by 9% back in January. Mine supply simply is not growing fast enough to keep pace with demand. Silver mining is a slow, capital-intensive business. You cannot flip a switch and produce more silver because prices go up. The lead time between a mining company deciding to expand production and that new production actually hitting the market can be 5 to 10 years. So even if the incentive to produce more is clearly there, the supply response is slow and uncertain. Meanwhile, demand is coming from multiple directions at once. Industrial demand for silver in solar panels, electric vehicles, semiconductors, and electronics has been growing steadily for years. New demand from silver solid-state batteries threatens to drive silver into an even more acute shortage, with silver being a critical input not just for solar, but for electronics, data centers, and medical devices, and manufacturers cannot simply opt out when prices rise, because for many factories, silver is a small share of the finished product's cost, so they absorb the higher price and keep buying. That last point is worth sitting with for a moment. When something is a small percentage of your total production cost, but is absolutely essential to what you make, you are not very price sensitive. A solar panel manufacturer is not going to shut down their production line because silver went up a few dollars. They are going to keep buying whatever they need. If you are still watching and you are finding this useful, a quick like or a subscribe genuinely helps the channel grow and make sure these kinds of deep dive topics keep coming your way. It takes 2 seconds and it means a lot. Now let's keep going because there is more to unpack. Let's zoom out and think about the broader picture of what this divergence actually represents and what the range of possible outcomes looks like, because I want to be fair and balanced here. The situation is genuinely unusual, but that does not mean there is only one way it can play out. One perspective, and this is the more cautious, structurally grounded view, is that the physical market is sending an early warning signal that the paper price is increasingly disconnected from real-world supply conditions. When physical markets diverge from paper markets, history suggests that paper eventually reprices to physical reality, not the other way around. In other words, over time, the price that factories actually pay for deliverable metal tends to pull the paper futures price toward it, not the reverse. If that historical pattern holds, the implication is that the paper price has some catching up to do to reflect the tightness in the physical world. The other perspective, and this is the one that anyone being responsible has to acknowledge, is that futures markets are genuinely enormous and genuinely powerful, and they can stay disconnected from physical reality for longer than many people expect. Market participants often misinterpret vault movements as indicating genuine scarcity. When the underlying drivers can tell a more complex story, financial institutions sometimes pull physical metal for regulatory compliance or portfolio diversification reasons that have nothing to do with industrial shortage, and corporate treasury departments increasingly view physical silver holdings as supply chain security rather than speculative investment. So not every bar walking out of a COMEX vault is a sign of impending squeeze. Some of it is just normal portfolio management. There is also the question of eligible inventory. Remember, eligible silver, the metal that is stored in the vaults but not currently warranted for delivery, could theoretically be converted into registered silver relatively quickly if the financial incentive was strong enough. When eligible silver is re-registered, it increases deliverable supply. So the registered pile is not necessarily the absolute ceiling on what could be delivered. It is the floor that is immediately available, not the total amount that could potentially be mobilized. CME Group's decision to raise margin requirements for silver futures contracts served as a natural moderator of speculative excess, prompting shifts toward more cashback trades and long-term holding rather than leveraged speculation. Exchanges have tools they can use to manage extraordinary situations. Higher margin requirements, position limits, and other mechanisms can slow down or redirect the kind of delivery pressure that would otherwise turn a structural story into a sudden disruption. That is worth keeping in mind as you think through what this all means. Global silver price discovery remains a multi-center process. COMEX and the London Bullion Market Association retain substantial weight in establishing the international benchmark price that most contracts and transactions reference. The shift toward Eastern pricing power is real and happening. But it is gradual. The idea that one day you wake up and the entire pricing mechanism has flipped overnight is not how these things tend to work. They tend to shift over months and years, not in a single dramatic moment. What does all of this mean for you as someone trying to understand the silver market? Here is the simple framework I would encourage you to use. Think of it in terms of two signals, the paper signal and the physical signal. The paper signal is what you see on your trading screen, the futures price, which is shaped by monetary policy, dollar strength, speculative positioning, and all the usual macro factors. The physical signal is what is happening in the vaults, in the delivery data, and in the premium markets like Shanghai. And right now, those two signals are pointing in very different directions. The paper signal is relatively calm. The physical signal is flashing tightness. The price sell-off in silver earlier in 2026, after it hit record levels near $121 per ounce, and the physical delivery data moved in divergent directions. Physical silver continued leaving COMEX vaults, even as the paper price pulled back sharply. The vault drains did not stop just because the price came down. That is the divergence in its purest form. Price goes down, physical demand keeps going. If demand were purely speculative or momentum-driven, you would expect it to fall with the price. The fact that it did not is a meaningful data point. Silver reached record highs above $114 per ounce in early 2026, then pulled back 31% to trade near $80, prompting headlines warning of overvaluation and speculative excess. Yet data from deeper within the market, specifically from COMEX exchange and physical inventory shifts, tells a very different story. Beneath the volatility lies a tightening physical silver market that could lay the foundation for the next leg of a long-term cycle. That tension between the headline price story and the underlying physical story is precisely what makes this moment interesting to pay attention to. There is one more angle I want to bring in before we wrap up, and that is the role of industrial demand as an anchor for this whole situation. Silver is unusual among precious metals because roughly half or more of its demand every year comes from industrial applications. Silver is a critical input for solar panels, electronics, electric vehicles, data centers, AI hardware, medical devices, and precision manufacturing. Chinese manufacturers cannot simply opt out when prices rise, because for tens of thousands of factories, silver is a tiny share of the finished product's cost. They buy regardless and pass the higher input cost on to the end user. This is fundamentally different from gold, where the bulk of demand is financial and can evaporate quickly when sentiment shifts. Silver has this industrial base that keeps pulling metal out of circulation no matter what the paper price is doing. That is part of why the vault drains have been so persistent over multiple years. It is not just speculators chasing returns. It is factories consuming metal to make real products. When you combine shrinking supply from miners with rising demand across multiple industries, the result is exactly what the data is showing. A market that has been drawing down its reserves for 6 straight years with no relief in sight. 6 years is a long time. It is not a temporary anomaly. It is a pattern. And patterns that run for 6 years tend to have real structural causes that do not resolve themselves overnight. So where does this leave us? The honest answer is that no one can tell you with certainty how or when the divergence between the paper price and the physical reality gets resolved. Markets are complex, and they can stay in unusual states for longer than anyone predicts. What we can say with reasonable confidence is that the signals coming out of the physical silver market, the vault drainage at COMEX, the persistent Shanghai premiums, the consecutive years of supply deficits, the accelerating industrial demand, those signals are all pointing in the same direction. They are saying that the real-world silver market is tighter than the paper price currently reflects. For the everyday investor trying to make sense of all this, the takeaway is not to panic or to rush into any particular decision. The takeaway is to understand the difference between the two markets you are watching when you follow silver. The paper price is a financial instrument shaped by leverage, speculation, and macro forces. The physical market is the real economy of silver. The factories, the vaults, the delivery data, the premiums being paid by buyers who need actual metal. When those two things agree, the picture is simple. When they disagree, as they do right now, it pays to ask which one is telling the more reliable story about where the market actually stands. The coverage ratio, the percentage of paper contracts that could be satisfied with registered physical metal, is the clearest real-time signal about what is happening underneath the surface of the silver market. When it stays low for extended periods, market participants who need deliverable metal are competing for a steadily shrinking pool of it. Keep watching that number. Watch the registered inventory trends. Watch whether the Shanghai premium narrows or widens. Those 3 data points, taken together, will tell you more about the real health of the silver market than any single price quote ever could. The paper market is quiet, but the physical vaults are sending a very clear message if you know how to listen. That is the story of silver right now, and it is worth understanding. Thanks for spending your time with the channel today, and I will see you in the next one.